Hello and welcome to the Mayar Capital Q2 questions and answers session. For those of you who have not yet had the pleasure of meeting, I'm Lee Overall Gibbons. I'm the head of sales and client relations here at Mayar Capital. More importantly, I have two guests with me, Aziz Al-Nain, who is the MD portfolio manager of the Mayar Capital Responsible Global Equity Fund. And I also have Aubrey Brocklebank, who is a deputy portfolio manager and the head of investment research here at Mayar Capital. So welcome, gents, and welcome to everyone who's joined us here today. Now, I'd like to thank you all for the questions that you have posed. It's really your opportunity to ask the team your burning questions. We are live, so we are here, and you can send through your questions whilst we have this session, and we will do our very best to answer them also. But before we kick into the questions, I've just got a little bit of housekeeping for you. So for the best possible viewing results, please can you put your view on the speaker view? It will give you, I'm told, a fantastic view of us three. And for any questions that you're putting through live on this session, if you can pop them in the questions and answers section, that would be superb. So coming to the questions that you've posed, and I hope you're ready for these, team, because they're very good. So thank you again in advance for those. First question is, what is the outlook for 2025 if we start to see interest rate cuts this year?
The answer is with Aubrey.
As I think we've said quite a few times, we don't really try and predict what is going to happen to interest rates, and actually then trying to predict the second order effect, becomes really too difficult to actually action on a long-term basis. We are long-term investors, but if interest rates drop, yeah, there's probably going to be a spike to maybe some growth names, but also to the sort of, bond proxies. And then what else might happen? Well, then you're going to have currency effects. Depends on who's dropping interest rates. Is it America? Yeah, is it Europe? Is it the UK? That's going to have, or potentially could have currency effects. I mean, we really try and build a portfolio that is going to weather all storms. So if interest rates go up or down, we like to think that we're going to have businesses which are not going to be adversely affected too much by these sort of things.
Yeah, I think the only thing I would add is, and this is more of a multi-year view. I'm not particularly trying to predict, like Oprah said, 2025, but I would be very surprised if we got back to the rates of 2021 and that freak environment, potentially in our lifetimes, to be completely honest. I think that was, people got used to a period post-GFC of lower rates and then extremely lower rates kind of after the pandemic. And I don't think that's normal. And from some of the adjustments that we've seen economically have to do with that. I think that was an aberration. And just looking at history, I doubt that we're going to see that again. It could possible. I'm not saying it's impossible, but I doubt it. I think when people are talking about rate cuts, when central banks are talking about rate cuts, they're not talking about going back to zero. They're going a bit lower from where we are now by 100, 200 basis points. I don't think we go back to zero.
Until the next crash.
Well, we'll see. When the next pandemic.
Yes.
Well, I suppose then coming on to what's been happening quite recently, particularly in the US markets, and specifically on the political scene. So thinking about US politics, potential change in leadership, what do you feel are the potential impacts of that on the fund and the companies that we invest into, should we have a change in leadership in the US?
Well, I think the question seems to be specifically, at least how I understand the question, If the person who asked it thinks I misunderstood, please put it in the chat. But it seems to focus on the U.S. presidency specifically, and I think people overestimate in general how much the U.S. president can do. It is one of the weakest executives in the world compared to, I think, the Congress and what happens there is a lot more impactful on what happens economically and internally to the U.S. That being said, we are not in a position to predict who's going to win. And even if we were, I don't think we can predict the outcome on either the economy in general or the market in general. I think trying to do that is just a waste of time. I don't think it can be done, to be completely honest. Like Aubrey said, we try to build portfolios that work in multiple environments. There are specific risks depending on what happens in Congress that do impact some industries more than others and so forth. And we do look at that in the context of that specific company. If we own it or if we follow it, it may impact our bear scenario, it may impact our bull scenario. So we do think about it at the micro level, I guess. But even then, we're not trying to guess what's going to happen. We're just trying to project different scenarios and incorporate the different scenarios into our analysis. But I don't think anyone knows what's going to happen or the impact of it.
Do you think that it could have a potential impact on the technology stocks? And obviously, we've had a lot of news on things like the Magnificent Seven. We spoke about them recently, and they're forever in the press.
Well, okay, so there is the issue of Taiwan, and Taiwan is the sort of modern day Arrakis. Sorry to anyone that hasn't read Dune, but Arrakis is the sort of controls all the spice for the galaxy, and it's the most important planet in, well, I mean, I guess it's probably a bit like Saudi Arabia in our world. But all of semiconductors come out of Taiwan nowadays, all the sort of bleeding edge semiconductors. So if China were to invade and take over Taiwan, we would be entering a whole new world that we could not understand. And the markets took a bit of a tumble the other day, and I think NVIDIA and TSMC took a bit of a tumble when Donald Trump said that he wouldn't necessarily support Taiwan. So you could project scenarios like that as possibly happening. I mean, we don't spend too much time on that because we don't have exposure to TSMC or NVIDIA. But if it were to happen, it would impact a huge number of other stocks, and it would impact us in ways that you just cannot fathom.
I would argue that if that happens, your portfolio will be the least of your worries.
Yes. One interesting thing, though, that actually some work we did do the other day was on Vestas, because we know that Trump doesn't like it. And I don't know if he doesn't like competition from hot air, but but so we looked at it, and there are things that he could do to offshore wind. But actually, we looked at Vestas's exposure to offshore wind, and it's remarkably small.
In the US?
In the US. Yes, it would impact growth, and it would be a negative if he were able to do extreme things. So we do look at our portfolio, and as you say, what are the risks that we need to stress ourselves to? But we're not going to sort of go out and try and find new ideas on the basis that, Donald Trump might win, therefore defense stocks might do well, therefore, we wouldn't buy them anyhow. But
interesting concept with regards to Dune. I absolutely get that, being a big fan. Those who also are fans, I'm sure you do too. Sort of coming back to the fund, and it's had a challenging period. What are your thoughts with regards to the performance of the fund looking forward? And again, mindful that we don't have a crystal ball, but I'm sure that a lot of people are asking that question. We've had that one come through.
Yeah, I mean, obviously, as I've written in my last 3 letters, we're not happy about the performance over the past 3 years, especially over the past 18 months. It is both on an absolute basis and on a relative basis, and I think we need to think about them a bit separately. I think on an absolute basis, is the part I'm most disappointed with, because we should have done better given the circumstances. But I think coming out of COVID, we did kind of take a conservative approach in how we were positioned in terms of what names we owned, how much cash we held, even our assessment of future growth and valuation. The economy turned out to be a lot stronger than we expected, both coming out of COVID and into kind of the rate hiking cycle that we've seen. And that meant that we did not participate as much in the upside since then. I think on a relative basis, our performance is not out of whack with other funds who follow a similar strategy. And it's almost entirely driven by lack of exposure to things, the Magnificent Seven, basically. And basically, we've seen a divergence between the S&P 500 and the S&P 500 equal weight. So, and a way to think about this is basically the difference between the market overall, which is heavily impacted by big tech names, and the average stock in the market. And the average stock in the market has done very poorly over the past 3 years, as we have basically, very similar to what we've done. Whereas most of the gains came from these big tech names, and they've driven that. And we've wrote about this last quarter and the quarter before and the quarter before that, and we talked about also in our AGM. But just to put things into perspective, in terms, the last time you've had a magnitude of difference between the average stock and the index driven by tech names, the last time it was at this level was in January 2000. So we are looking at territory that we've seen before. It is extremely extreme, and there is probably a better way to phrase that sentence, but I don't think this lasts for a very long time. And I don't think this is natural, and I don't think this is healthy. And I have high confidence that it will reverse. Now, is it going to happen next month or next year? I can't tell, but I don't think it's going to last for 3 years. And I've said that last quarter, and I will keep repeating, I do think if you want to look at even that simple measure of the average stock versus the S&P 500 or people like us relative to the benchmark, I have very high confidence that the next 3 years are going to see one of the best relative performance in a very, very long time, because you're going to see this massive reversal out of this very extreme case. It's happened to us before in leading up to 2008. It happened to me when I was investing in 99, 2000. I think this is the exact same scenario repeating itself. And I think it will reverse.
So with that in mind, and again, we don't have that crystal ball, but what could be the catalyst for that? Or are we starting to see signs of change, albeit subtle signs in the marketplace already?
I think often valuation is its own catalyst. Things just get to the point where prices are so high that they embed extremely ridiculously high expectations that companies just cannot live up to. So they start to report, and the numbers might be good, but it's not as good as what's implied by investor expectations in the price. And then you see that triggering a sell-off in one name, and then another, and another, and then it dominoes. I mean, that's what happened in previous cycles. So you don't even have to have a recession, for example, for that to happen. It could be purely an issue of these names basically coming down. And that's pretty much what happened in 99 and into 2000, where the drop happened in the tech names purely because investor expectations just got to a point where there's no way companies can live up to that. I don't know if you've got anything to add.
Well, I suppose maybe one of the other catalysts is, I'm sure you've all seen the sort of chart of new technology, where you have the sort of the slope of the hype, and then the despair, and then you go to the plateau of productivity, or whatever they call it. And it does seem with AI, with being at this hype, and maybe we're on the way up or not, but it does seem that with AI, that whilst it has the potential to be absolutely transformative, I will not disagree there. There seem to be very few actual monetary use cases that are actually fairly high tech. A lot of the use cases are pretty low-tech chatbots and things that they're not really groundbreaking. They're not the sort of thing that you really want to go and, spend billions, if not trillions of dollars of CapEx on. So I wonder if people are going to start getting disillusioned. I mean, I heard one story that Sony, they have an enterprise ChatGPT license. And, well, I asked you, but Lee, how many licenses do you think Sony have for this? How many seats? How many people are using ChatGPT Enterprise? And this is as of a few months ago. Maybe it's...
Must be billions.
30.
30?
Yes. I mean, so this is the thing. A lot of people just aren't using it. Now, I think that they probably should be, and they should be, or at least exploring how to use it. But it is very hard to use this to actually produce something that is really worthwhile. And it will come, but when people start to get disillusioned, that's when we might see not as much VC money going into new AI stocks. That in turn is going to dampen demand for new chips. I mean, it's one thing we know about NVIDIA is that they've been actually funding a lot of their own customers, which does mean that their revenues have a lot of circularity in that you have a startup that goes, hey, I want to use AI to, I don't know, analyze widgets. And NVIDIA goes, sure, here's 100 million. And then a few venture capitalists go, yeah, well, because NVIDIA investing, we'll invest too. So they get 500 million. And they go and spend 500 million on NVIDIA chips. Great strategy, but how sustainable is that? So once we start seeing, perhaps the hype disappear, then that might be a catalyst. But who knows when that's going to happen? In the meantime, I think we'll just focus on what we like. But we've said many times before, boring is beautiful. We're going to focus on the more dull companies that we think have really good chances of outperforming over the long term. And you said, how happy are we with performance? And yeah, I think we ought to not beat ourselves up too much because do remember that there are two mandates we have: outperformance at lower risk. And this is the problem with taking lower risk, that we can never show you what the other door was. We can never show you the world in which actually inflation didn't come down as fast. We can't show you the world in which supply chains didn't rectify themselves, where money wasn't injected into the system. We can't show you those worlds. But in those worlds, I think we would have done a lot better than our peers. And capital losses would have been fairly small for our portfolio, whereas for the market as a whole, they would have could have been very severe. And we don't know what probability that was. But we will always try and protect risk first. We'll try and protect downside first. And sometimes that means that we are going to underperform. And I'm not saying it makes it wholly excusable, but I don't think we need to start the flagellation just yet.
And then the other thing is, I think the past 3 years, which is one of the things that we're talking about the past 2 months, we're comparing to how things 3 years ago. It was our peak alpha at that point. So we're lapsing kind of really difficult comps going there. So that just in and of itself, just the passage of time, will change that. But I do think in the end, this will pass. Our performance will look better 3 years from now. And it'll just be one other period like what's happened when I was managing my first fund in 07, 08, and then my portfolio kind of around the time of the tech bubble. It's just going to be another proof that over long periods of time, value investing and our strategy and buying good businesses and not overpaying them does work over time. Just every now and then you're going to have a period of underperformance, and that's the price that you have to accept. That with any strategy, really, any strategy is going to have a period of underperformance. That's the truth about it.
And like you said, is that there are other global strategies in exactly the same boat at the moment for those that aren't engaging with things like the Magnificent Seven.
Well, anyone who doesn't own a Magnificent Seven, and it's been pretty tough to own them anyway, not just for us, but even for people who are growth investors, because you would have had to put a third or 40% of your portfolio in one industry and put it in one country, one industry. That in of itself is so risky that most active managers can't do it anyway from risk perspective in and of itself. Even if they were growth investors, which we're not. So you see that even people who are growth investors are not keeping up with this. I'm convinced it's a phase that will pass. We're going to forget about it. A couple of years from now, we're going to be talking about something else. And people who are buying these names now are going to be in a lot of pain. I'm sorry, but there's no better way of putting it. And ask me in a year and we'll see how it goes.
Thank you very much for that. And to the audience, again, please do pose your questions. We are waiting for them to come through, and very much I will be posing them to the guest speakers. So I would urge you to ask your burning questions. But coming back then to the questions themselves and the fact we've just talked about where the fund is at. Tell us about what you're excited about. What's in the portfolio that you're excited about at the moment?
Yeah, so maybe I'll talk about some of the things that we own and some of the things that we've been working on. But the past several months have been extremely fruitful, and in terms of both new ideas and adding to some of the things that we already owned. We're actually at the lowest cash allocation in many years. Do you remember the last time we're basically at 0% cash, which we haven't done, with the exception of briefly kind of during the first lockdown, COVID. Yeah. I don't remember the last time we had zero cash. So that tells you how bullish we are about the opportunity set that we see. We've added the most number of names in our portfolio the past 12 months, with the exception of during COVID, during the first lockdown. So that tells you kind of how excited we are in terms of the opportunity set that we're seeing.
Not to mention our WIP, our work in progress, which I think is probably at the highest level as well. You know, I look at our pipeline of the stuff we're working on, and I'm more excited about that than I have been in a long time.
Yeah, and this is one of the weird things. Again, this is exactly what happened in 99, 2000, which is the indices were at high levels, and it looks like the market is expensive, and it looks like there's nothing to do.
But capital's been starved from
from
the really good, interesting business.
Yeah.
Well, the businesses that we consider interesting, which everyone else considers boring. But hey,
But exactly. But you look right under kind of the top few names, and you look at these wonderful businesses that are trading at very reasonable valuations. They're doing well. They've survived an interest rate cycle and are in good shape. They've survived inflation, and their margins are either fully recovered or recovering towards where they were. So everything is going right for them, and they're still at a reasonable valuation. And our challenge has been really just saying no, because there are a lot of, and then just trying to figure out, do you want this thing or that? And there are a lot of great opportunities out there.
Exciting. So I suppose then sort of moving forward, and again, I'm looking at your scenario testing, how these companies get through the full process, your investment process. You know, can you sort of give some insight? Because obviously there's a whole host of companies out there. You know, you have to go through an entire process in order to make it through. How does a company get through that?
Want to take that?
Yes, with difficulty. So the first thing is we run it through a health check. So as we've said many times before, we like to kill ideas quickly. And this is because when it was just Aziz and myself, and there just was not enough time to look at, there wasn't enough time to waste on an idea. So when you're at a big firm and you have 20 analysts, you know, each analyst can spend days, weeks, months on a single name, and if nothing comes of it, it's fine. But we don't have that luxury. You know, if I were to spend a month on an idea that doesn't actually make it into the portfolio, that is a month wasted. You know, and obviously I'll hopefully learn a lot from it, but you know, that can be a huge waste of time. So we realized we had to be laser focused on how we prioritize ideas and how we look at them to begin with. So we've employed this accounting health check, which is part quantitative. And when I say quantitative, I just mean lots of ratios and going through a scoring system. Part qualitative, but looking for very simple things. Does the company have egregious related party transactions? Do they have strange use of variable interest entities? And a whole host of things that we have just seen in so many frauds and accounting manipulations in the past. And we really try and do that fairly quickly so that we can just say, no, not worth it. And yeah, actually, it's funny because I thought that this would be the sort of thing that everyone would do, or that lots of people do. But the more people we speak to, the more I realize that very few other people do this, which I find bizarre because it's, apart from anything, when you look at accounting red flags, if you do it after you've looked at the business, if you go, okay, right, here's a business that makes widgets, and you start to understand the widget market, you start you spend a lot of time on it. So it's so much harder to then say no to that idea once you've spent hours and hours reading about it and learning about it. Whereas actually, if you do the accounting health first, you don't have that bias, you don't have that sunk cost. So we do that first. And at the same time, we're also looking at the environmental and social. We're looking at, does it follow, have net zero policies? What are the social policies? And there's a whole load of data that we look at there. Does it fall within our mandate, obviously? Any restrictions? Do they do, and do they do anything that you just go, that's really just not something that we want to invest in, something that we wouldn't sleep at night investing in. But that can all happen really very quickly. And then after that, we then start to say, okay, well, now let's have a look at the quality. Let's see, is this a sustainable business? And when I say sustainable, I don't mean that in an ethical way. I mean, is it going to be able to sustain its returns for the next 10, 20, 30 years? Does it have barriers to entry? Can it defend itself against competition? Does it have an economic moat? Then we'll look at the growth and we'll say, okay, what is the growth prospect of this business? What is the growth prospect of the market? We'll break it down. So fairly granularly looking at volumes, looking at pricing, looking at mix effect. We'll also try and use base rates. Is this a GDP +1 business? Is this about population growth? Is this aging population? Then we try and sort of come up with sort of some really simple mental models that allow us to map out what sort of growth we can sort of underwrite. What growth can we underwrite from this business? So if you look at Visa and MasterCard, well, they control X% of consumer spending. So what does consumer spending do? What does cash usage and card usage? What is it now? What has it been? And what do we think it will be in the future? What is Visa and MasterCard's market share of cards? And once you do that, once you just do those sort of three simple little things, actually you get to a pretty good estimate. I mean, it's really not too dissimilar from a Fermi problem. From asking yourself, how many piano tuners are there in London? Okay, we won't do that now, but that will give us an idea of what the growth is. And then after that, and there are a few other steps, but I'm trying to keep it fairly simple. We'll look at what are the real economics of the business. Because with most business, well, actually, let me start again. Accounting is an interpretation of the economics of the business, but it is just one person's interpretation. So we will look at it and say, okay, well, what's our interpretation? How are we going to understand what the real economics of this business are? Is this a business that actually should be capitalizing more costs? And were you to do that, does that mean returns on capital are much, much lower? And therefore, it's actually not as great a business. Is it a business that maybe is currently underutilized for whatever reason? So an example we often give is fleet maturation, where with something like Bright Horizons, where You have a company that opens a whole load of new stores, but those new stores are not as profitable because they're new. And so you have to sort of go, okay, well, if all those new stores were at maturity, what is the actual earnings power of that business? What is the earnings power of the whole business? So we try and really sort of look at what is the economic reality of this business. And that is so important, because only after then can you start to think about valuation. And then valuations, we have our bear case, our mid case, and our bull case. For our sort of 4 main drivers, we look at what the historic correlations have been, because some businesses are pro-cyclical, where you have growth, and when you get growth, you get a margin enhancement. Other businesses, however, are the other way around. That actually, when growth goes up, it's only because they're spending so much more money on sales and marketing. So in order to get that growth, they have to depress their margins. So we'll look at that, and then we use a Monte Carlo simulation to give ourselves a distribution of returns, because that then tells us what is actually an appropriate margin of safety. I mean, one of the things I think both Aziz and I were frustrated with about value investing is everyone talks about this margin of safety, but no one could put a number on it. No one could say, people would say, oh, 20%, 30%.
Why?
Yeah. Why is a 30% margin of safety for a business as robust and secure as Unilever the same that you want for a business like Methanex, which is a commodity producer of methanol, that has a volatility 3x that of Unilever's? You can't apply the same number. So we wanted to actually have something that was quantitative, that actually made logical sense to us. And that's what we did. But it also allowed us to perhaps be a bit more nuanced on how we exit positions. Because here's the thing, when you have a target price, your sort of mid-range, that's only a right price if you're right. But we know that the chances are we've been too conservative. So actually, what we can do is we can trim when it gets to our mid, but only when it gets a little bit higher to the sort of top quartile do we then say, okay, let's now cut completely. Because what happens with so many fund managers is they get to that target price, sell, that's it, don't revisit the business. And they lose a lot. So we want to have that sort of extra bit that encompasses the fact that our mid-range is almost seldom going to be correct.
And I know we're pretty much out of time, but I want to add a couple of things. One, on the issue that we were just talking about, and I think the term we sometimes use is dynamic positioning. But essentially, when you own a portfolio, the weights are always drifting. So stock prices go up, stock prices go down. So the weights are changing. And in theory, at least, absent any kind of transactional costs and with perfect knowledge, neither of which are true, but in theory, there's no way that the optimal weight for a position, knowing the future with perfect foresight, should be the same in these different scenarios, right? And so in a perfect world, you would be adjusting the weights in a real-time basis, like literally by the second. Now, the reality is we don't have perfect foresight, and there are transaction costs. And so what we end up doing is we
don't have quantum computing.
And we don't have quantum, yeah, there's that too.
Yes.
Yeah. And so we do adjust the weights because the attractiveness of the positions that we own relative to each other, relative to the market, relative to cash, relative to risk do change from time to time. And having that range of forecasts gives us a framework where within it we can adjust these things in a way that is intellectually consistent, that is mindful of the risks, that is mindful of the fact that we often do not know a lot of things about the future. And so I think that's another reason to have it, because the truth is we can, is Unilever going to grow at 3% or 5% in 2028? I don't know. It could, both numbers are plausible, and often we can set, even in bear cases, and make a plausible case for either. So it's important to be mindful of what we don't know, not be overconfident, and build that into the process in the way that Aubrey talked about. And then the other thing that I think I just want to add to that before we close is I've found over time that people in our industry feel that they have to have an opinion about every stock and everything. And you just don't have to. And frankly, you can't. And so it is, we have to accept that in some cases, we're just going to stop looking at a company because A, it's too hard, which we cannot know it. Someone else might, but we can't. And we have to accept that that is a plausible outcome. And often it's not even an issue of, and if someone asks us about what do you think this company is worth, we also have to accept that the answer can be, I don't know, and that's okay. In the same way that we just talked about, I said, I don't know about a lot of macroeconomic things, but even some companies, you could look at a company and we, after doing some work, we don't have to say no because it's cruddy or there's a problem with it. But sometimes it's too hard, basically. We just don't know. And it's okay. There are a lot of opportunities out there you don't know how to.
Hundreds of other companies, thousands of other companies.
Yeah, so I think we are about out of time, and we're certainly out of questions. And again, I'd like to thank you all for those that have contributed, and likewise the granularity that you have both shared with myself and the audience today. I think it's really exciting in the sense that, you know, this is a fund which has continued the test of time. It does what it says on the tin. You're sticking by your process. You've got an exceptionally thorough and strong process which continues. And so we would like to thank you for your continual support into the fund itself and for Mayar Capital. If you have any questions that come up post this, then do send them to the IR team, and myself and Kate will be happy to answer those and speak to the team on your behalf. But other than that, I will draw this session today as a close and thank you for your attendance and wish you a good day.
Thank you.
Thank you.